In this series, Mint Makes You Money by Everyday CPA, we're going to talk about why and how personal wealth begins not with good investment decisions, but with good spending decisions, and how and why we like to use Mint to help us do this. Welcome to the Everyday CPA channel, helping small business owners and families better manage their businesses and their families. This program will help you learn and adopt the strategies and tactics on business and family accounting and budgeting, credit management and improvement, and ways to build and grow savings to help you compete, win, and succeed, and hopefully live a happier, healthier life. In this series, Mint Makes You Money by Everyday CPA, we've been telling you that good personal financial management is the first step to building savings and wealth. This episode is focused on some tips and tactics on what you do with those savings that you've created by better managing and controlling your spending. I will give you 3 key tips in this episode and 2 in the next episode. These 5 tips will help you avoid making bad decisions and hopefully make some great decisions on the wealth you have been building through your better spending and budgeting plan. Hello, this is Kelly at Everyday CPA. As you begin to manage your expenses better, you will quickly realize you can accumulate savings because you are no longer spending all of your hard-earned money. Rather, you're spending some and saving some. The first goal should be to accumulate enough in savings to pay for 12 months of living expenses. Maybe you title it Disaster Savings. It is intended to be an account you never touch. It is your backup in the event you absolutely need it in an emergency. The next goal should be to start building wealth. And that's what today's 3 tips are about. So let's get busy. Tip number 1, take advantage of any employer-sponsored 401k plan. Especially take advantage of the matching component. When you put your money away in a 401k plan, you don't pay any income tax on that. So you immediately generate about a 10 to 15% return on savings right there through cost avoidance. Yes, you will have to pay that income tax later, but you get to earn on those funds you save now. In addition to this return, you get the return created when your employer contributes to your 401k. That varies from plan to plan, but between these 2 elements alone, the return on investment in your 401k can be in excess of 15% without taking any risk to do this. Tip number 2, investments need TLC. I don't mean tender loving care, rather transparency, liquidity, custody. Transparency means you need to see what and where your money is. Liquidity, this is how quickly you can get your money out and at what cost to get your money out. Is there a charge or fee or commission or a penalty to get your money out? You want to know this. The third is custody, and this in my mind is the most important. Who or what is actually holding your savings or investments? Is it a bank that has a guarantee by the U.S. government that your funds are safe? Or is it a guarantee from a financial advisor working out of his parents' basement trading stocks? Tip number 3, Big D. I call this the tip you heard from your grandmother. Don't put all your eggs in one basket. Today we call it diversification. In the investments and savings world, you have 3 levels of diversification. I call it ACD. A, asset diversification. C, company diversification within the asset class. D, decision maker diversification. Let's talk about the first big D, diversification of asset class. There are 3 main asset class types: cash, stocks, and bonds, plus alternative investments. Alternatives include cryptocurrency, real estate, hedge funds, venture capital, and there are loads of free information available on the internet. So structuring a savings plan around this model is a good way to build a portfolio. That's asset diversification. The second big D is company diversification. In each of the asset classes above, you can diversify by selecting different companies or entities within those asset classes. You can either elect to invest in individual companies or entities or a collection of them in the form of a mutual fund or exchange traded fund, ETFs. And that leads to the third big D, decision maker or influencer diversification. I'm going to cover in the next episode the differences between these types of decision makers or influencers, but let's just agree that there are over 10 million of these advisors and brokers and agents out there. Like any profession, there are good ones and bad ones, but there's one thing that both the good ones and bad ones have in common is that they make money, and they make money from your savings and investments. And this leads to my fourth point, which we will cover in the next video. Be careful of the fees and costs related to your investment portfolio. So that's it for this episode. Tip number 1, take advantage of your employer's retirement plan. Tip number 2, TLC, transparency, liquidity, custody. And tip number 3, big D, diversify assets, diversify companies, diversify the decision makers or influencers who advise you on what to do with your savings. That's it for now. This is Kelly at Everyday CPA. Thanks for watching.